Good evening, traders. Welcome to your 7-minute market update utilizing technical analysis to predict direction based on human emotion. Today is July 17th, 2012. Lots to talk about, so let's get started. This is a chart of the SPY, which is the ETF that tracks the S&P 500 if you didn't already know that. Alright, I pretty much say that in every single one of my videos, but just in case somebody new is on, you just never know. In any case, brief history here. We had this down move. We had this huge red candle here right into these two mathematically calculated levels here. I said previously that if we actually close below this trend line here, and not only that, confirm that close by closing below that close below this trend line here, then that would confirm that the move should head lower. On this day here, we actually closed above, and then that gave us a pop, which I told you in the previous video. This is probably a head fake. And I still stand by that. This is a bull trap in my opinion. Okay, and I did say in the day before yesterday's video that we probably will get a 25% retracement, which is what we did yesterday here. Normally after a big move here, we get a 25% retracement, especially when that move happens on low volume. Okay. Alright, so with that being said, basically what happened is we created this doji candle, just taking it a couple steps back. We did not do it on higher volume, so that this does not constitute a move that's going to last very long in my opinion. Okay. This move here is basically, in my opinion, because it's options X week, meaning this is the week that options expire, which is Friday. Options actually expire on Saturday. I don't know why, because you can't trade options on Saturday. But technically speaking, options expire on Saturday, which means Friday is the last day you can execute an option if that's what you wanted to do, or sell your option for a loss or for a gain. In any case, so we had this huge move, right? And then we had that 25% retracement, created this doji candle. A lot of people thought that it was going to reverse back down. I'm not sure who else was saying it, but pretty much from what I saw, I was the only one that said, no, I think it's going to continue higher up to into this 137.06 level. We actually came down today and tagged this 20 moving average and then popped right back up. We came close to this 137.06 level, but we didn't quite make it there. Does that mean I do see some more high side tomorrow? I think there's a possibility, but right now this is where it gets a little bit tricky. It gets tricky because, again, I would preferably like to initiate shorts, and I'm going to contradict myself, so just keep that in mind. But I like to initiate shorts towards the end of the options expiration weekend. So I'm just going to tell you a little bit of some patterns that options expiration normally does. Okay, so sometimes the beginning of the week it'll be down, right, and then the ending of the week it'll be up. And the reason why the institutions do that is because they want to stop people out. They want to whip people in and out of the markets. Let me give you an example. This is a 10-minute chart of today's trading. As you can see, this is obviously something that you normally don't see on a day that's not part of the options expiration week. We had the beginning of the day here and the ending of the day here. I mean, they bring it down here. We hit the 200 moving average. A lot of day traders jumped on the long side. We went up and we bullishly consolidated. We went up again, we bullishly consolidated, we went up again, we bullishly consolidated, and then now we're still in this consolidation pattern. And the only reason why I say that is because although we did close below the 20 moving average, we did not confirm below this 20 moving average with another candle closing below that. What the institutions did was they propped the markets higher towards the end of the day, making the day positive, up 93 cents. Keep in mind the volume is only 138 million and our average is 150 million, so we are still in low volume territory. So this gives the institutions the ability to prop the markets higher, in which case that's what they like to do, and they like to whip people in and out of the market. That's how they make their money basically. Okay, after it's all said and done, when you look at the daily candle, which is this one candle here, I mean, it looks like a regular candle. Looks like it opened here, came down, and then eventually went all the way up here, and then pulled back, and then closed about here. Now, essentially, after you look at the daily, the intraday chart, you can see that that wasn't the case as smooth as I just said it. It's a little bit more whipsawed out today, but that's normal for this week, okay? And because this is only Tuesday, we got 3 more days in the week. I do hope, I will say this. One thing that's kind of bothersome is that we did have this candle here created on higher volume. Okay, it wasn't ecstatic volume. I mean, I want to see volume like this. If today's volume was all the way up here, then that would have been great. But today's volume was better than the past 2 days. That shows a little bit weakness to me, meaning the markets are probably going to turn over, if not already tomorrow, very soon. So I don't. I was hoping that the short would actually happen all the way up here into the 138 level. In fact, if it hit this upper trend line, if it looked like it was going to hit this upper trend line sometime the end of this week, then I would actually wait for that to happen. But it looks like that there's a possibility we may stall out around these areas here where we have these calculated levels. In addition to that, we have this double top. I'm not even sure we make it to the double top just yet. I mean, the volume is just too low. The volume is increasing, however. Now, what I want to see is some sort of doji candle of some sort, some kind of shooting star candle. The candle that looks like this, as an example. And mainly that indicates a candle pattern reversal. Okay, but I also want to see it on substantial amount of volume, preferably a volume of this around here, like this kind of volume over here. This is the kind of volume I want to see that indicates exhaustion to me. So if I see a candle that's created like a doji candle here, or a shooting star type candle like over here, this isn't really a shooting star because it's not at the peak, but if this was at the peak here, then I would definitely go short on the SPY. Okay, so let's take a look at the dollar. All right, this is the daily chart of the US dollar. Let me load my drawings in here. We can take a quick look. You see how this 2280 level is still there, it's still hanging tight. It still was not able to close or tag it. This level here, it looks like we had like a double bottom, and then it kind of recovered, and then it came back down into this double bottom, giving the markets a prop higher. So in the if you look in the beginning of the market, as the intraday of the market, let me show you the differences between the two here. Okay, so basically, as I've been saying in previous videos, when the dollar's up, the market's down, and when the dollar's down, the market's up. And this is a tick for tick inverse. It's not for point. And as you can see, this is the starting of the day, and this is the ending of the day. This is a 10-minute chart for both. Let me just kind of zoom in here. All right, so we have a better picture just like that. We have a better picture just like that. In the beginning of the day, the dollar caught a bid, which in turn, the markets sold off, right? And then later on in the day, the dollar pulled back, and then the markets went higher. So it's an inverse, one for one, but it's just not dollar for dollar, penny for penny, and that's why we have different types of candle patterns. Okay, so let me go back to the dollar. All right, so I'm still in the camp that if we hit this 2280 level, so there's still a possibility that the markets could go a little bit higher. What I'm thinking is, this is something, a guesstimation is not what the charts are telling me. The charts are telling me right now that the market still has a potential of going higher. But due to the volume has increased, although it's still below the average. It's increased higher than the previous 2 days, which is telling me that exhaustion is coming along, and is soon to turn over, in my opinion. Okay, so unless that changes, right, and anything can change because nothing is 100%. But unless that changes, for now, I think that the markets has a chance to go a little bit higher, but it's soon to turn over. I mean, it could actually turn over as soon as tomorrow. Okay, in any case, this is what I see. Because we have a little bit more downside as a possibility for the UUP, which is the US dollar, into this 2280 level, as well as this 20 moving average coming right under it, and this bottom trend line, and we also have this 50 moving average now all under it. This whole area right here is a huge amount of support. Eventually the dollar is going to get a bounce and go higher because the dollar is still in a confirmed uptrend. There's nothing telling me that the trend has changed. Therefore, what I'm saying is that the market does have a chance of going a little bit higher before the market catches a bid, and then the markets are going to turn over and start coming back down. Okay, with that said, let's take a look at the DX. This is the US dollar futures. Okay, so it's basically the UUP, except this is the dollar future charts. Let me just load my drawings in here, and then this is what I see. Okay, so we had this double top over here from here to here, as we discussed in the previous videos. We didn't confirm above this candle, so we're starting to break down. And I did mention in last night's video that we're probably going to get some support right around this level here. We haven't quite tagged the 20 moving average just yet, so again, there is a possibility that tomorrow we may have some more upside. Now, this is my guesstimation, going back to what I was talking about before. This is not what the charts are telling me, but this is just something that I commonly see. Tomorrow we may actually gap up and then just start selling off already. Okay, and then tomorrow being Wednesday, or we just continue higher into that 137 level, in which case I'll be prepared to short. Now, if we get into this 137 level on Friday, then that'd be prime for me. If we get to it on Thursday, then yeah, I may still think about taking a short, simply because it's close enough to the end of the week. And starting next week, even if we do go higher, I don't really think that the market has that much more to go. Now, in my opinion only, this is obviously not a recommendation to buy or sell anything. My style of trading is, even though I'm certain, or I have a 90% certainty that the markets are going to start turning over, I'm not going to go all in. I'm not a gambler. I have a set amount of money that I always put in, and I have my low, my medium, and my high. I never put in my high. It's very, very rare that I put in my maximum amount. Okay, my maximum amount is only 10% of my capital, but I rarely go that high. Okay, I normally just put my medium amount, and at in small situations, like in the case of Walmart, where you have a stock in relative strength, I'll put in a small entry, so a small position for Walmart. So my medium position is something that I'll probably be looking at to put in, which is my standard. Even though I think the markets are going to come down, I gotta play it safe in case I'm wrong. 10% is still a huge percentage. I once watched a YouTube video. If you guys search for, I think poker something, I forget the name. Maybe I'll post it on this video later, but in any case, there was a 90% chance that this guy was going to win over this girl, and it was just two players left. And because the guy had a 90% of winning, he put it all in. He put all his money onto the table, right? And then the lady thought he was bluffing, so obviously she said, okay, I'll go all in as well. When they both showed their hands, and then they had the river card and whatever, I'm not really sure how they play that poker game. In any case, she noticed that she only had a 10% chance of winning. So before even looking at the last card that they flipped, she had already folded, and the guy ended up winning. Well, that's normally what that's the standard, because she knew she had less of a chance of winning. There's almost no way of winning being only and 10% probability when the guy had 90% probability. What a fact of the matter is, the last card that they flipped was actually the winning card, and she went from 10% to 100% win, and she would have won the game if she hadn't folded the cards. The whole point of the story, the moral of the story, is even though you have a 90% odds in your favor, it doesn't mean you're going to win. So you should never go all in. Okay, you should just keep your standard, in my opinion, and just in case you're wrong, and the markets do go higher because Uncle Ben comes online, and we do know that the markets are manipulated, and it's not something to complain about. It's something that you have to embrace and expect, because the markets have always been manipulated. Then you just got to kick back and not worry about it. And if you don't have that much money into the market, then you won't worry as much if the market goes against you. And if you take a stop, that stop will just be a small stop, and it won't it'll be a small loss. Okay, so anyways, let's talk about STX, which is a trade that I entered today. All right, this is Seagate. I talked about Seagate before. A little bit of a history. I actually shorted Seagate at this level here. um, and I also I sold my short, or I covered my short down here. Okay, so the reason why I covered was because it was into these two mathematically calculated levels. In addition to that, it was on this bottom trend line. And I did mention in the previous video that if it does tag this upper trend line here towards the end of this week, I'll probably take another short. It's still Tuesday, and this is the contradiction that I was talking about earlier in this video. I still took a short. As soon as it hit this trend line here, I took a short, so I'm currently in the money now, and I already have a break-even stop. So even if Seagate does break through here and gets into this 28.46 calculated level, it's not a big deal. I just stop out for a break-even. I wait for it to hit the 28.46 level, and then I take another short. All right, so the good news is I'm still in the money right now. I have a break-even stop because I hit this upper trend line. The bad news is we're still in options expiration. Monday was a flat day. Today was an up day. Tomorrow could possibly be another up day. Normally, it's going to be in the beginning of the week, it's up, and the ending of the week, it's down, or vice versa. Or you're going the flat day is normally Wednesday. But wherever the flat day resides, you're going to look for either two consecutive up days or two consecutive down days. There after the two up days, I have seen options expiration where the whole week is low, but that's you have to look at what the general public is thinking. Everybody's thinking that this is a bearish market. If everybody's thinking it's a bearish market, then everybody's buying puts. Puts is shorting the market in the options trade. So what institutions will most likely do is prop the markets higher and stop everybody out of their puts. It makes sense, right? And that's how they make their money. Sometimes when it's there's a lot of panic, there's institutions aren't able to do anything about the sell-off, and they'll be forced to sell off as well, which creates a huger, much bigger sell-off. Okay, so this is why I shorted the STX. Not only did it hit this upper trend line here, but I don't think it has much more upside, and earnings isn't until the 20 something, I think it was, or was it August, until the 30th. Okay. All right, so this is what I'm looking at. Basically this, we hit the 20 moving average a second time. Again, I don't like using abuse levels, but this is a rising, this is basically a pretty big bearish flag pattern. Okay, so here's the deal. If we got 3 more days. If this candle cannot close under this 20 moving average by the end of this week, then I stop out for a small loss. Okay, that's how I'm gonna play this. If it stays, I'm sorry, if it closes under this 20 moving average by the end of this week, because this is a weekly chart of the STX, then I hold on to my short, and I expect the short to at least get into this 50 moving average. If, however, it closes above like it did today, but on Friday, at the end of the day, Friday, or 5 minutes before the end of the day, Friday, it looks like it's going to close above this 20 moving average, then I stop out for a small loss, and that's just the game I play, and that's how I play it. Okay, so that's the STX. All right, this is daily chart of Apple. Actually, this is the daily chart of Apple right here. So let me just load my drawings in here. All right, so what did Apple do? Apple is right into the 612.34 and then pulled back. Isn't that amazing how these I mean, this level is already used and abused already, so I would never make a trade based on this level yet, because it's already been used. But you can see how powerful these mathematically calculated levels can be. It's not 100%, but a lot of times you'll see stocks react around these levels over here. So let me kind of just zoom in. Apple was only up 3 cents today. That's showing me relative weakness, especially when the markets were pumping higher at almost $1 on the SPY. Apple does have earnings next week on the 24th, so that's something to keep an eye on. Can Apple break out of this bigger bearish pattern? That remains to be seen, and I don't play with earnings, so we'll just have to keep an eye on that. Apple has almost the same pattern as the STX. You have this down move here. We have this bearish bear flag pattern here. We're right into the 612.34 level, so there is a possibility that we may break down. This is the weekly chart of Apple, so this next week, if we can still trade within this trend line here, then the bear flag is still in play. And if the earnings are bad or does not meet expectations, then obviously Apple will be coming down sharply, because I do think that Apple is not maybe not overpriced in the fundamental analysis, but overpriced in the general trading population, simply because a lot of times fundamentals, in my opinion, doesn't really work out too well because of the volatility and the manipulation that the markets already have, and it's only getting worse. I mean, the value of certain stocks, it really isn't. I mean, you have stocks that are valued high, but it's trading really low, and it'll never get any higher, and a lot of people lose money buying into stocks that way and whatnot. I like using technical analysis because it really doesn't matter how good a company is. What matters is what everybody else thinks a company is. Meaning, if everybody else or institutions and stuff like that think the company is great, then the stock will go higher. And if they don't think it's great, but it is a great company, the stock's going to go lower. It doesn't matter how good the company is. What matters is what other traders think, and then that's why I use charts to determine where the general consensus is in any one given stock. Okay, so moving on. Okay, one stock I'm seriously looking at. I really like this FCX for a short. Right now it has this little small bullish consolidation, but we do have these two moving averages right over it, giving it a little bit more pressure. The bigger picture is still a bearish consolidation pattern here, which then could in turn come down. So what I'll probably do is wait till after earnings. The earnings is on the 19th, which is, I believe, next week. What is today? No, it's Thursday. So maybe sometime next week, if the pattern is still bearish like this, then I'll probably initiate a short on the FCX. I would really much rather see it come into here. In fact, if the FCX has good earnings, right, then there is a possibility that we could spike all the way up into this level, in which case then I'll take another short, and that's something that I want to keep an eye on. The institutions are not buying into the FCX, so the McMoran copper and gold, so I just have to wait, and I don't want to jump in too early or too late. I have to be patient, and patience is key, and capital preservation is also key, and money management is the most important thing in trading, in my opinion. Okay, so that's pretty much it. I'm pretty much out of time. This is your 7-minute market update. I really appreciate you guys stopping by and taking a look at my videos, and God bless to you all, and I'll hopefully see you in the next video.